Appreciate you being here. Normally, you see, we kind of record kind of behind us, but in this case, I have to think outside the box and come across some fun technology here. So, Tim, welcome. Thank you so much for being here today.
Thanks for having me, Eric. And obviously, these types of meetings, kind of the sign of the times right now, right? Everyone taking caution and doing what we can to keep from spreading virus around, I guess.
Nope, it is. So I know there's been a lot of interesting. I've got probably before I even found out that the Feds lowered the rate there, maybe earlier last week, and I got all these texts calling me going, "Hey, should I refi because the rates are at zero?" And I'm all, okay, but how did that get to zero? So then I quickly looked up and saw all these different things. So why don't you explain kind of how that and what that means when that went to zero and what that means for home loans?
You got it. I'll try and explain from like a 10,000 foot elevation and try not to get too detailed. So, and you think your phone was ringing, you should have seen ours. Everyone wanting 0% loans. So let's, I'll just back up I'll back up in time, way back to 2 weeks ago. The Fed had an emergency meeting. It was a Sunday that they did this. And the big announcement is that they were lowering the Fed rate to zero, between 0.25%. We'll just call it zero. And everyone reacted, and understandably so. Oh my gosh, interest rates are zero. I need to go buy a house. I need to refinance my house and get a 0% mortgage. To be clear, mortgage rates are not zero. Okay. And what's important to know is the Fed rate isn't what drives or dictates mortgage interest rates. Now, interesting about the Fed's announcement was they did do something that has a big impact on mortgage rates. And what they did is they announced a new QE, which stands for quantitative easing policy. This is to kind of stimulate the economy. And 2 weeks ago, this policy was for $700 billion. That's a big number. That $500 billion was going to be going towards U.S. Treasuries, and the other $200 billion towards mortgage-backed securities. And this is what initially was going to drive our rates down, and it did. Right out of the gate, we saw rates really come down. So now let's fast forward in time and get you caught up. What's happened as a result of this is the interest rate market has become extremely volatile. We're seeing rate changes all throughout the day, both up and down and all over the place. I'll say it's exciting, and it's important to stay on top of it as well. So 1 minute, just to tell you how volatile it'll be, 1 minute we'll see rates in the low threes, and by the afternoon they're upwards of 5%. The next morning, they're right back down in the low threes, and then midday, and these changes. Well, in the fashion of what the Fed is doing right now, trying to continue to stimulate our economy, on Monday this week, they changed the numbers of the $700 billion. They basically came out and said, all bets are off. There is no cap anymore. The Fed is going to continue to throw money at this to hopefully continue to stimulate our economy. And once again, a lot of money is going into mortgage-backed securities, driving rates right back down in a big fashion.
So where are currently rates now, though, if somebody is still interested? Because I know that with this, still the rush with the lower interest rates is created this frenzy of people wanting to come, to get a lower rate. So where are rates at this current time?
Okay, so I was just looking at some rates just before you and I got on this call, and rates were from the mid to low threes on a 30-year fixed loan. And the same with the government products and stuff. But here's an interesting thought, Eric, and you and I actually didn't talk about it. So I'm gonna side blast you here a little bit. You and I have both been in this business a long time. I know I have a tremendous amount of respect for you and the job you do, and I know you're very well respected in your community.
Thank you.
And I've never believed that someone wakes up in a day and says, I think I'll buy a house, but only if I can get 3%. Or I've never believed that somebody says, I'm going to refinance my house, but only if I can get 3%. I've always believed there's another need there. There's something else driving. Right now, a big concern for a lot of folks wanting to do refinances is there's some uncertainty, question marks in their mind regarding our economy, with things that are going on. So they're looking at doing debt consolidation. Is that rate driven? No, they're looking to wipe out some debt. Now, whatever the rate ends up being for that, yes, we get to the point of having a conversation regarding what the rate is. I just like to point out, I don't know that it's the main motivating factor, as much as most of us are trained that way, right? To think rates are great, you got to do a loan. I like to focus on there's got to be something else. And yes, rates are great. Let's face it, right? But it's the same thing when someone buys a house. Are they needing a larger home, a smaller home, a relocation into a different school district? Those are the things that are driving them. In my opinion, that's just my take.
No, that makes sense. That makes sense. So for people doing who want to refinance now, or what are we talking the time frame? Because I know with the COVID-19 and things kind of taking place here, what does the mortgage industry look like, and is there been any changes that you see that of the time frames to be able to get loans and getting refined?
Absolutely. And you're right about changes. Things are happening every day, all day long at a very rapid pace. And mortgage lending is really focused right now with what we refer to as the agencies, Fannie Mae and Freddie Mac. Okay. And then again, we're getting off into the Wall Street part of the conversation. But here are some of the changes that we're faced with right now. Normally on a transaction, you have to order an appraisal. Right now, we have appraisers that don't feel comfortable going inside properties. So what do? We have mobile notaries that don't want to go sit at someone's kitchen table and sign loan docs. So what do? Well, the answer is, and Fannie Mae and Freddie Mac just came out with an announcement yesterday. I received official notice this afternoon that they're expanding appraisal requirements. So if an appraiser is not comfortable going inside a property, they now have the ability to change their format, use drive-by type appraisals, if you will. And Fannie and Freddie both have expanded their guidelines regarding property inspection waivers, meaning where we don't need an appraisal at all. And I actually think this is some of the silver lining for everybody, is that as we move through this, and we will, that our industries, Eric, are going to look and feel completely different, than what we've been used to.
Very true. I totally agree with that. And share with the audience what you shared with me before we went live here about in regards to how many trillions of dollars, what the average was and what the trillions of dollars is trying to get through the system right now and how that's affecting things.
Yeah, so typically annually our country funds and closes roughly $2 trillion alone in mortgages. And right now the industry is trying to fund and close $5 trillion in 1 month.
Yeah,
it's a massive number.
Yeah,
which, by the way, in itself has created its own issue. So back to one of your original questions regarding time frame and what to expect in lending. For example, on refinances right now, the shortest lock period is 60 days. Okay. On purchases, it's 30. We can still close purchases relatively quick, within that 30-day time frame. On the lending side, keep in mind, we still have other hurdles, right? Appraisals, notary, escrow, those things that are all being worked through in the industry. But yeah, refinance is 60-day lock period minimum. We're hearing rumor of some lenders that are not allowing loans to be locked until which time they're ready to draw the loan documents and close. Now we're not there, but I am hearing rumor on the street about that.
That's interesting, actually, because that kind of changes things as well. So how can they find you? How can they find your wonderful company?
Well, we're all over Facebook, of course. Stanford Mortgage is all over Facebook. We have 10 different offices between Northern California and Northern Nevada. If anyone wants to write it down, my direct phone number for my office is 916-941-3485. And anyone I ask, please reach out with any questions. If someone just wants to have a conversation as to what do we think is going to, how this transpires and looks as we move forward. I love having those conversations. If anyone wants to come down below the 10,000 foot level to dig into the market and the economy, I'd be more than happy to have that conversation as well.
No, you know your stuff. I know you well. Thank you for that, keeping it kind of at least where we all kind of understand. Because I know there's a lot of buyers out there saying, okay, is this a good time? Should I go? Should I, not? I mean, I've got many listings that we've got going. I'm continuing getting phone calls from buyers, asking questions. And what I kind of like too is that I'm personally feeling is that we're kind of a little bit more secluded up in Placer, Nevada counties, up a little bit north. And so what I'm enjoying is that we are still getting a lot of calls from the Bay Area, more people in the city limits that are now realizing that maybe they can work from home more often now and then make the move quicker. And so I think that we're going to see this boost of just great buying presence here soon, as soon as we get through this. So,
well, and I would agree. And Eric, let me just add to that real quick. I talk to a lot of clients as well as you do, and there are some people that are thinking, well, I want to wait. I want to wait because I think property values might come down. Well, it's important to understand what the gamble is there. So I'll give you some rough numbers. Let's just assume the price on a house went down 4 months from now by $20,000. The interest rate today is 3.5%. 4 months from now, if the interest rate is 5%, which it made more sense to buy the house today. You see what I'm?
Yeah.
And I can do some comparison reports, but again, it comes down to affordability. In fact, you and I were on a meeting earlier today, and you made a very valid point that at 3.5%, you can buy this much home, right? Let me get my hand on my screen. But at 5%, you're buying this much, right? And there's a big difference in buying power today as a result of where rates are. For sure.
That's true. I always tell buyers though too, and sometimes they'll say, "Hey, yeah, how long have you been looking?" And they go like 2 years. And you go, "Okay, well, what's stopping you?" And so it's finding that right home, and it's again finding that. And I always feel that hey, we don't know where the market's going up or down, and we know interest rates are like almost free money right now, which is great. So the question really is that if you have a good job and it's going to be, you feel comfortable and you're going to buy the home, how long do you plan on staying in the home? And most people are right now, I know the average has gone, even closer, was it 9, maybe 9 years of that. So if you're planning on staying in your home that long and you feel comfortable with today's payment, then you if the market does go down, well, it's going to go back up. And so you're going to be fine. But what you really have is you have a home. You have something that you're living in and creating memories. So that's what I like to tell people as well.
Well,
so.
I love to hear you say that. And you said something very, very important as far as I'm concerned, Eric. And that is, if everything is secure with your job and you're feeling good about where we're at, given all the stuff that we're all dealing with right now, well, then yes, it's a great time. If there's some questions like I'm not sure or how do we deal with this? Well, that's when counsel is going to come in. You, me, somebody else, Stanford Mortgage, their lender, whatever the case is, those are the kind of conversations that we should be having, not just buy, or refi. It should be really, where are they? What are their needs and wants? How do we help, Eric? That's really the question. And there are a lot of people with concerns out there right now.
Yeah. And that's so nice that a lot of people don't understand is that when they feel like, hey, you're going to go call a real estate agent, a broker, or a mortgage lender, they feel like, oh, I don't really want to bother them. But there's so much that our audience needs to realize that we're here to help you. We're here to, and you're here to help them. So we'll say, you know what, if you want to call Tim, he'll take 20, 30 minutes with you, whether you buy a house with him or not. He's still going to be that type of person to help. And that's what we're kind of consultants here of helping people through a difficult time. So thank you.
Yeah,
right,
no problem.
Appreciate you. Appreciate everything that you've done and what you bring to the table. And thanks for your
keep up the great work. Yeah, a lot of stuff, a lot of moving parts going on. I look forward to giving you updates, as many as you want.
Appreciate it. So maybe if you see down this thread here online that if there's some new updates you want to just add to the feed from comments, feel free just to do that.
You got it. Thanks.
All right.
Eric.
Appreciate it. All right. Have a wonderful day. Take care.
Bye.